I would want us, ladies and gentlemen, today to look at planning and operating variances. Ladies and gentlemen, things change. There is nothing that is constant in this world. Change is a normal thing. So what will normally happen is that we will do our budget. We have done our budget nicely. By the start of the year, we start putting this budget into operations. We start applying the budget. In between that year, coronavirus knocks. We had a college in this case that had a good budget, very good forecast, that by this particular time, maybe it is the college where I teach, by this particular time, we're projecting in this case here to be having like 200 students. Why? Because of course, exams would have been over a long time ago. This would have been a new month for new admissions. So the enrollment would have been so low. So we must have had our own plans. But currently, how many do we have in college signed up? 0. The place is locked. So in this case here, if we continue using the old budget, we shall be deceiving ourselves, because that old budget is far away from the truth. And that is why whenever things change, it can only be good if we are to revise our budgets. So we must revise our budgets. And the moment we revise our budget, then we shall be having our original budget. We shall be having here our original budget, the one that we prepared at the beginning of the year. And then in between the year, we have revised budget. We have revised our budget. And then, of course, at the end of the year, we'll have what we call the actual profit and loss account, which we shall be making comparisons with. So we have the actual profit and the loss what year account. Actual profit and loss account. Could you kindly write these 3 things? These 3 things are the bedrock of our discussions today. Today we are not going to discuss so many things. We have original budget, we have the revised budget, we have the actual profit and loss. Kindly write the 3 things. Write the 3 things there. I'm waiting still to hear from Mercy, whether Mercy has been able to know how to share her screen with us, so they can buy this lady good breakfast. Good breakfast in hotels, for example, that don't accept Kenya shillings. Yeah, you finish eating like this, these guys would want you to pay them in dollars, like Panari. Those are the great hotels. Yeah, full breakfast, great. Okay, ladies and gentlemen, having drawn this, buy her the golden coffee at Kempinski. Very good. Mercy, that golden coffee is yours. Share with us, Mercy, as well, your solution. Your solution, we buy you that golden coffee. Now, ladies and gentlemen, here we are. Listen and listen to me very well. So when we have revised our budget, we shall be doing now 2 comparisons. There will be this comparison where we shall be looking between the original budget and the revised budget. We will be comparing the original and the revised. This variance will be called the planning variance. The variance we will get there will be the planning what year? The planning variance. And then, ladies and gentlemen, whenever you have revised being compared with actual, revised being compared with actual, we shall be having what we call what year? Operating variances. Operating variances. Operating variances. Operating variances. So what are we saying? Whenever we are comparing, ladies and gentlemen, listen to me. You know, budgets are tools of what year? Planning. So when you're comparing between 2 budgets, then whatever variation will be getting there will be called a planning variance. When you're comparing between revised and actual, now, of course, revised and actual will be yielding what we call the operating variances. operating variances, operating variances, operating variances. So today's topic is very, very important, very, very important. I hope you have written there planning and operating variances, and I hope you have got today's date up there. You know, this is a normal class, so I expect you to have written today's date. How many have written today's date up there? Is there any, or that is not examinable? We must make this just like the normal class. Our normal classes, you're taking notes, the way we take notes in our normal classes, etc., 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 etc. So when they talk of planning variances, when they talk of planning variances shall be comparing between the original budget and the revised budget. And then operating or operational variances, we shall be comparing between the revised budget and the actual profit and loss account. With me, is a simple question. Is a simple question that I would want us to do. Let me pin this question for you on the screen. Let me pin this question for you on the screen. I hope everyone is able to see that question. It's a good question, which I expect you guys to go through, and then we try it together. So we are told there, a company makes a single product. At the beginning of the budget year, the standard labor cost was established to be $8 per unit. And each unit will take 0.5 hours to make. However, during the year, the standard labor cost was revised. Once I read that, I'm so sure of what is needed. Once I read the concept of revised, I know whenever there are budgetary revisions, this examiner will always want us to calculate the planning, to calculate the operating variances. So we're reading this together. They're telling us that, however, during the year, the standard labor cost was revised. A new quality control procedure was introduced to the production process, adding 20% to the expected time to complete a unit. In addition, due to severe financial difficulties like the ones which you are facing because of this COVID-19, the workforce reluctantly agreed to reduce their rate of pay to $15 per hour. In the first month after revision of the standard cost, budgeted production was 15,000 units, but only 14,000 units were actually produced. This took 8,700 hours of labor time, which cost $130,500. Required, they want us to give them the labor planning and operational variances in as much detail as possible. In as much detail as possible. So what I will do when I get this kind of a question, I'll have to organize this question in the form of these three aspects. In form of the three aspects, in form of the three aspects, in form of the three aspects. So please write again these columns the way I told you to write them. And then you come and give us the labor cost. And give us the labor cost. The labor cost in each of the three column titles. Labor cost in each of the three column titles. Labor cost in each of the three column titles. So please show us the question, pin the question for us. So I would want to fill this. So like now they are saying a company makes a single product at the beginning of the budget year. The standard labor cost was established to be 8 per unit. And each unit should take how many hours? 0.5 hours. Now listen and listen to me very well. We are saying here, for the original budget, we need 0.5 hours for a unit. And each hour should be going for a rate that I don't know. But what I know, at the end of the day, the labor cost per unit is $8. A whole unit will be taking $8. A whole unit will be taking $8. Will be taking $8. Now, from there, ladies and gentlemen, we go to we continue reading the question. Let's continue reading the question. Let's continue reading the question. Let's continue reading the question. We are told, ladies and gentlemen, I'm repeating again the first paragraph. A company makes a single product. At the beginning of the budget year, the standard labor cost was established at $8 per unit. A whole unit is 8, not per hour, but per unit. And each unit should take 0.5 hours to make. However, during the year, the standard labor cost was revised. A new quality control procedure was introduced to the production process, adding 20% to the expected time to complete a unit. So in terms of hours, ladies and gentlemen, this revised time will be 1.2 times 0.5 hours, which will be equal to what? Yes, remember, they are telling us, because of some technicality, we are to do some revision. We are to increase our expected labor time by 20%. So 20% more, that is 120. So 1.2 times 0.5. Could you kindly give me this figure? What is 1.2 times 0.5? Kindly give me this figure. Kindly give me this figure. 1.2 times 0.5, 0.6 hours. So 0.6 hours, and then of course they have given us the rate per hour. If you continue reading this, they're telling us a new quality control procedure was introduced to the production process, adding 20% of the expected time to complete a unit. In addition, due to severe financial difficulties facing the company, the workforce reluctantly agreed to reduce the rate of pay to $15 per hour. So at least here they have given me the rate, the revised rate, which is 15 per hour, meaning that a whole unit will be 0.6 times 15. A whole unit will be 0.6 times 15. Could you kindly give us an answer? 0.6 times 15 gives us what answer, ladies and gentlemen, here? 0.6 times 15 gives us what answer? Give us 9. Yeah. 9. Thank you and thank you very much. Thank you and thank you very much. So $9 for a whole unit. We continue reading the question. We continue reading the question. We continue reading the question. So we are told here, ladies and gentlemen, we are told in the first month after revision of the standard cost, the budgeted production was 15,000 units, but only 14,000 units were actually produced. This took 8,700 hours of labor time, which cost 130. I'm interested in the labor cost. I can see the actual time. 8,000 what here? 700 hours. 8,700 hours. 8,700 hours. At a total cost of 130,500. At a total cost, the total labor cost is $130,700, like that. 130,700, like that. 130,700, like that. So, ladies and gentlemen, from there, what do we have? Required, calculate the labor planning and the operational variances in as much detail as possible. So, of course, you and I know the labor cost variances. Yes, we appreciate the various types of labor variances that we have. We know that there are labor rate variance and the labor efficiency variance. So we have here labor rate variance. So the labor cost variance is full column. We're writing there labor cost variance is full column. We have the number 1, labor rate variance and the labor efficiency variance. And I would want a good student to write for us the formula of labor rate variance. A good student to write for us the formula of labor rate variance. The formula of labor rate variance. The formula of labor rate variance. What do we have there? Labor rate variance. Formula. In the chart section. In the chart section, is there somebody who is able to see or to remember the formula of labor rate variance? I'm not seeing anybody writing anything. Thank you very much. Thank you very much, Maingi. We have Francisca. Francisca was with Francisca in the morning for AFM. That's very good. So we have the labor rate variance equals difference between two rates. We have the standard rate minus what here? The actual rate. Thank you and thank you very much. Standard rate minus actual rate. And then outside, we have the actual what here? Actual hours. Actual hours. Actual hours. So ladies and gentlemen, this is not our normal variances. No. They want us to split this labor rate variance into labor planning variance and the labor rate variance, which is operational. And whenever I'm given a chance of computing between labor planning and the labor operational, normally start with the operational. Normally start with the operational labor rate variance. The operational labor rate variance, just to disturb you. Who remembers? For operations, during operations, for operational variances, we normally compare between what and what. For operations, we normally compare between what and what. We normally compare between what and what, somebody. Very good. We normally compare between the actual and what here, actual and revised. Meaning, ladies and gentlemen, my formula still stands, but I do appreciate the fact that here I will be using the revised rate, and here I will be using the actual rate because it's operational. Operational, I'm comparing between revised and actual. So, ladies and gentlemen, I will come and compute my operational labor rate variance as follows. Remember, in full, if I were you, I would have written this as standard rate per hour. In a full SR stands for standard rate per hour. So when you look for the revised rate per hour, it is this 15. Not 9 is for a whole unit. The rate per hour, the revised rate per hour is 15. So here I have 15 minus the actual rate. The actual rate can only be obtained. From the actual information. The actual rate can only be obtained from the actual information. And I can see here that 8,700 actual hours actually cost me a total of 130,700. Therefore, the actual rate will be 130,700. Divide this by the number of hours, 8,700. And then outside here, we have 8,700. Outside there, we have 8,700. So if that happens, ladies and gentlemen, then what figures am I going to get somebody? So you open brackets, you say 15 minus 130,700 divided by 8,700, you close times 8,700, and then you give me an answer. Somebody is getting for us 130, 500, but he forgot to tell us whether it's favorable or adverse. Is it positive or negative? 130,500 F or A?
Getting 200 A.
Oh, there are others who are getting different.
200 A.
Sorry for this. I'm being given that the right answer is supposed to be 200 negative. We don't write the negative, we'll simply say 200 what here? Adverse. That is the operational labor rate variance. Operational labor rate variance. Ladies and gentlemen, please extend your great work by giving us straight away the operational, give us the operational labor efficiency variance. Give us the operational labor efficiency variance. So I can see most of us getting 0, 0, 0. I can see one person getting 4,500 negative. Let's see. First of all, we have to appreciate the efficiency variance. That anytime you hear of the efficiency variance, remember of my friend from this Indian community who is very efficient. Remember Indian community, even this Kempinski that this great lady was talking about here. If you go to Kempinski Hotel, I have to believe in the top management. You must get Indians there, right? Those guys are efficient. They know how to manage people. They're so good. Losses really to them is not a language that they understand. So anytime they talk about efficiency, what do we know about efficiency, labor efficiency variance? We always think about Mr. Shah. So Mr. Shah, and then of course outside we have SR. We have got SR outside there.
When you say the 0 is for LRV.
Or LRV was 0.
Yeah.
So I'll go back to that one. I'll go back to that one. I'll go back to that one. But before I go back to that one, come here. Labor efficiency variance. Labor efficiency variance. Labor efficiency variance, ladies and gentlemen. We have SHA. SHA stands for what? This SH stands for what? Standard hours for actual production. Standard hours for actual production. Standard hours for actual production. So remember, under operations, we are comparing what and what. Under operations, we are comparing revised versus actual. So these have to be revised hours, and these must be actual, because under operations, I'm comparing between the two. And operations, I'm comparing between the two. So ladies and gentlemen, that our operational variance, labor efficiency variance, will be equal to the standard hours. I can see here in the revised budget, each unit is 0.6. So I will take this 0.6 multiplied by the actual production. Multiplied by the actual production, because remember, capital SH, it must be standard hours for actual production, meaning that I must involve number of units here that were actually produced. If you read this question very well, please let us read the question very well. If we read this question very well, paragraph number 2, you'll be able to see that we only produce 14,000 units. So I'll take 0.6 hours because I want standard hours. 0.6 hours times 14,000 minus the actual hours. Actual hours here were 8,700 minus the actual hours, which were 8,700. 8,700 multiplied by, come outside here, what do we have outside there, ladies and gentlemen? What do we have outside there? So the standard rate. Who can give us the figure that we should use outside here? The standard, what is the standard rate? What is the standard rate? Somebody?
15.
No. That is the worst blunder that you can ever do in your life. Could you kindly give me this rate here? If we are saying 0.5 times x equals 8, 0.5 times x equals 8, then what is the value of x? So that I can get to know the rate per hour. So we have here 0.5 times x, 0.5 times x equals 8, meaning that x will be 8 divided by 0.5, which will end up giving us what somewhere there? 16. So here we have 16 per hour. I would want to you to listen to me very well this morning. When we are talking of operations, etc., planning, normally that variance comes in between what we have in brackets. Remember, variance is subtraction. What we have in brackets there is where we shall be featuring the issues of planning and the issues of what operations. Otherwise, outside brackets, when they talk of standard rate, it must be the original. Outside brackets, you don't look at what are you comparing between what. No. Outside brackets, when they talk of standard rate, it must be the very original standard rate. And the very original standard rate that we have here is 16. Not 15. The moment you put 15 there, you'll be wrong. I'm explaining this again. Whenever we talk about operations you can see when I've written here, revised, actual. But for whatever that is in brackets, whatever we have outside brackets, ladies and gentlemen, will be the standard rate, but it has to be original. What you're going to see is that whatever we have in brackets here, outside brackets, can either come from here or here. Whatever we have outside the bracket can never come from the middle. Parameters there. So could you kindly give me an answer here? For operational labor efficiency variance, what are we able to get somebody there?
Uh, 4,800.
4,800. I think there's somebody who had gotten this figure. 4,800 what here? Adverse, which is negative. Adverse, which is negative. and the verse is negative. Now, I would want us to make some reference. There is a question that we did here, which some students are telling me was not adding up. Some students were telling me was not adding up. What was this? Ladies and gentlemen, this concept of what here? This concept of labor rate variance. There's a figure they're telling me we got wrong. So you can revisit here. Operational labor rate variance. And operational labor rate variance, we said the formula is the same. It is standard rate minus actual rate multiplied by what here somebody actual hours. And remember during operations, what did we say? We said here we have revised, and here we have actual, because operations we will be comparing the revised budget vis-a-vis the actual P&L for us to be able to measure our performance. So here then we are reading the revised standard rate. The revised standard rate is 15. So 15 minus the actual rate per hour. Remember, the actual cost is 13700. Divide this by 8700. Multiply this with actual hours. So actual hours, ladies and gentlemen, how many actual hours do we have? We have 8,700 hours. Let's see whether we'll be able to get 0, because most of them are saying it's 0.
If I'm correct, Jonas and Mercy. Oh, they're saying it was 130,500 instead of 130,700.
Oh, the total cost. I mean, let's look at the question. Let's look at the question. So the question in terms of labor hours, yes, labor hours, paragraph number 2, it's 8,700 hours of labor time, which cost 130,500. Sorry for that. This is supposed to be 130,500. 130,500. So this is supposed to be 130,500. So could you kindly say open brackets there? 15 minus 130,500 divided by 8,700. Whatever we get there times 8,700. Please give us an answer now. 0, eh? 0. I'm being told here that this answer is 0. It's 0. So that is it. So could we kindly move to the next level, the one of calculating the planning variances. Planning labor variances. So mention there planning labor variances. So planning labor variances. So we have here planning labor variances. What do we have here under planning labor variances? We have 2 of them. We have the planning labor rate variance, and then we have the planning labor efficiency variance. Let's see whether there is any student who will be able to get this correctly very fast. who have completed, let's see what we have. Let's see what we have here. Planning, liberate variance. So first of all, they see the board. They see the board. So planning, liberate variance. What do we have? Just the normal variance. The normal variance where we have the standard rate minus the actual rate multiplied outside there with what you somebody the actual hours. And then I'll come and remember very fast. Planning, liberate variance, planning. Planning, I'm comparing two budgets. So for planning, I'm comparing the original versus what here somebody revised. I'm comparing the original vis-a-vis the revised. So in that particular case, ladies and gentlemen, listen to me very well. We have the first parameter here will be original. This will be original. Now this will be revised. Like that. Even if it's reading actual, but you know at the back of your mind, this is just for guidance purposes. Otherwise, this should be the revised what here? Rate. The revised rate. So then the original rate per hour, the original standard rate per hour, you guys gave me a figure of 16. Minus the actual rate which is revised. The rate which is revised here, you guys have given me per hour is 15. 15 multiplied by the actual hours. Now this is where very many students forget. The actual hours can only be obtained from the, remember this is not part of the planning. When we say actual, they can only come from this actual P&L. We say whatever that is in outside there, whatever is outside the brackets there, can never come from in between. So you talk of actual hours, it can only be this 8,000. See whether there is anybody who was able to get 8,700 favorable. 8,700 favorable. Boniface got this. Thank you very much, Boniface. Thank you very much, Boniface. The boy child, I can see the boy child is strong, huh? Very good. So planning, liberate, variance. How about the planning efficiency? How about the planning labor efficiency variance? The planning labor efficiency variance. The planning labor efficiency variance. The planning labor efficiency variance. So the planning labor efficiency variance, I know efficiency variance is all about Mr. Sharp. So we have here Sharp. Outside we have multiplied by the standard rate. And then I'll come and recall, they are talking about what here? They are talking about planning. If it's planning, I know that here we'll be comparing between the original versus what here somebody the revised. The original versus the revised. I want to see whether there is anybody who has been able to get an answer for us. I want to see whether there's anybody who has been able to get an answer for us. Is there anyone who has been able to get an answer for us? So what figure are you able to see, ladies and gentlemen, there? Share the question. Sorry. Okay. So I'll add you one more minute. I'll add you one more minute because I've not shared the question with you. Okay, so I can see they're getting 2700 adverse. I can see they're getting 2700 adverse. Come back here, come back here, come back here on the board. We have our planning, labor efficiency variance. So remember, capital SH stands for what? Standard hours for actual production. So if you don't make use of actual production where you're getting SH, then you can't be right. So I'll go back to the original standard hours, which were what here? 0.5. But now these have to be multiplied with the actual number of units that were produced. And if you pin that question there, I will be able to get the actual production very fast. The actual number of units here that were produced. In paragraph number 3 actually, where they are talking about the first month after revision of the standard cost, budgeted production was 15,000 units, but only 14,000 were actually produced. So then this will be 0.5 times 14,000 to get the total standard hours, minus the revised, of course I'm reading actual, but I know for sure that planning, we are working with revised hours. So the revised hours, I can see there are 0.6 hours there, but again, in totality, these have to be multiplied with this actual production, which is 14,000. And then at the end of the day, ladies and gentlemen, we have the standard rate per hour. Which standard rate per hour should I use outside here, ladies and gentlemen? Please help me. Which standard rate should I use here? The standard rate per hour. Somebody please talk to me in the chat section there. In the chat section there, please talk to me. They're not talking to me. Fine, they are not talking to me. They are telling me, Mwalimu, for standard rate, which figure do they want us to use their standard rate per hour? For the standard rate, which figure do they want us to use? Others are saying 15. Remember, outside here, what do we say outside here? We can never pick from the revised. We can never pick anything that is outside here, can never be picked from the revised. So it means that this SR has to be the original standard rate, which is what here 16. Thank you very much for trying. And of course, we're wrong. It's part of the game. It's part of the game. So then, could you kindly give me this answer? Kindly give me that answer. So open brackets here, 0.5 times 14,000 minus 0.6 times 14,000, close brackets times 16. Give me an answer. Are you able to see some answer being given there?
22,400.
22,400. Is it from one student only? 22,400 adverse. 22,400 adverse. I would want us to mark for ourselves, and I would want my friend here to pin the same question. To pin the question that we've been using on the screen. We pin the same question that we've been using on the screen. We mark for ourselves. Perhaps even the teacher will be wrong. No, there's nobody who is perfect. If you scroll down here, if you scroll down there, look at the labor rate variance. The labor rate variance go down a bit. Just continue. The labor rate planning variance, are you able to see 8,700 favorable? Were we able to get 8,700 favorable for the labor rate variance? Somebody. Labor rate variance, were we able to get 8,700 favorable? They're not talking to us. For the labor rate variance, were we able to get it? Yes, I can see somebody who is saying yes, thank you very much. How about labor efficiency? I can see labor efficiency variance. I can see labor efficiency variance. Labor efficiency variance, it's down here. It is 22,000, it's here. Labor efficiency variance planning, 22,400 adverse, it's there. And then we have the others. Where's the end? Yeah, we can see the labor rate operational. operational variance, you can see it here, ladies and gentlemen, the operational variance, which we got here, labor rate operational was 0. And then we have the other one, ladies and gentlemen. There is the last one, that seemingly is the end, but at least for the ones that you guys have been able to confirm, we are correct. Now, I would want us, ladies and gentlemen, to pick on another question. And then we do it ourselves. So this question is coming to you on your screens in just a minute. So it is called example 3.1. This example 3.1. Example 3.1. They are telling us product X had a standard direct material cost in the budget of 4 kilograms of materials of M at $5 per kg, giving us 20. Due to disruptions of supply of materials to the market, the average market price for material M during the period was 5.5 per kilogram, and it was decided to revise the material standard cost to allow for this. During the period, 6,000 units of product X were manufactured. They required 26,300 kilograms of material M, which cost 139,390. So they want us to calculate the material price planning variance, material usage operational variance, and material usage operational variance. Could you kindly just take like 5 minutes and try that question, part A? You can just copy the most important things. If I would even copy them in this format. Hiyo ukitaka vizuri unajisumbua akili, usitake starehe sana, unajisumbua akili, unaandika chini to make sure that we are focused, all of us, on this particular thing, which normally disturbs so many people, and yet it is the easiest. impressive. So what we need to do, I want to go through that question. So we have our original, just time to go through the question. We have our revised. We have the actual P&L. Actual P&L. So we start with the first one in the question. We are told, in the question there, we are told, product X had a standard material cost in the budget of 4 kilograms. So we have the material cost, how much? 4 kilograms at $5 per kilogram, $5 per kilogram, $5 per kilogram, giving us what total cost according to the question. The total cost, ladies and gentlemen, according to the question, the total cost here should be 20 per unit. $20 per unit. And then something happened in between here. There was some disruption. So we are told here, due to the disruptions of supply of materials to the market, the average market price for material M during the period was 5.5. They are not talking about quantity. The quantity to be consumed still will remain the same, but now the price here will be $5.5 per kg. So 4 kilograms times 5.5, 4 kilograms times 5.5. I'll use my calculator here very fast. 4 kilograms. So we have 4 times 5.5. So 4 times 5.5 gives us what, somebody there? Gives us 22. 22. And then what are they telling us about the actual? About the actual information. Actual information, ladies and gentlemen, they are telling us that during the period, 6,000 units of X were manufactured. So I have the actual output here. Actual output is 6,000 units which were manufactured. And then, ladies and gentlemen, we have they required 26,300, which cost 139,390. So they required 26. They just leave it there. They required 26,300. So kilograms here 26,000, 26,000, 26,000, 26,300, 26,300 kgs. Total cost is $139,390. So $139,390. And then now out of this, ladies and gentlemen, what they need me to do in the first question is to give them the material price planning. So I'll write here the planning material price variance. Planning material price variance. Planning material price variance difference between two prices. We have the standard price minus the actual price. And then outside here, we have the actual quantities of materials that were done, that were purchased. So come here, remember planning. Planning, we are comparing with, this is the plan. These are the plans. So planning, we are comparing here between original and revised. We are comparing between original and revised. So then the standard price per kilogram, original one, was 20 per kilogram, minus the revised price, not 20, it's 5 per kilogram, sorry. It's 5 per kilogram here, 5 per kilogram, minus the revised price per kilogram, which is 5.5, multiplied by the actual quantity purchased. Now we go to the actual information. Actual quantity purchased was 26,300 kilograms. Could you kindly give me that answer? Kindly give me the answer. Kindly give me the answer. 13,150 adverse. 13,150 adverse. I don't know whether there is anybody who had gotten this question earlier on before us doing it together. Is there anybody, my admin, from up there? Is there anybody who had 13,150 adverse up there? Did I die? Great. That's Jedida.
Calvin.
Calvin. Thank you very much. Now let's go to the second question. Please pin the question there. Let's go to the second question. The second question wants us to do something very easy. They want us to give them still the price, but this time round operational. So material, operational, we have here operational, material price variance. Operational, material price variance. Operational, material price variance. Could you kindly help us calculate that? Is there somebody who has a figure for us already? I can see Boniface has a correct figure there. Boniface has a correct figure for operational material price variance. I would want to get such a figure from at least 3 students for me to be able to get a whole picture of how my students are grasping these concepts. How my students are grasping these concepts. The same figure. Thank you very much. So please, if you allow me, I'll want to do this question. So operational material price variance. So it is a difference between two prices. Which prices are these? We have the standard price minus the actual price. And then outside, we have the actual quantity that was done what you purchased. But now remember, operations, ladies and gentlemen, operations, we are comparing revised versus actual. Revised, so the revised standard price per kilogram, revised standard price per kilogram is 5.5. Minus the actual price per kilogram, there is some division to be done. Because the $139,390 cost was required to procure all this. So we need to come and do a division here. So 139,390 divided by 26,300, that will give me price per kilogram multiplied by the actual quantity that was purchased. The actual quantity of materials is 26,300, like that. Let's see whether Boniface was able to get this correctly. Let's see whether Boniface was able to get this correctly. So open brackets there, we have 5.5 minus that divided by that, close brackets times 26,300. What figure do we have, ladies and gentlemen, there? What figure do we have, ladies and gentlemen, there? What figure? 5260 favorable. So here we have 5260 favorable. 5260 favorable. 5260 favorable. Now let us go to the last one. The last one, I go to the question. Please pin it up for us there. The last question there. The last question there. They want us to give them the material usage, but this time round operational. Material usage, operational variance. Material usage, operational variance. I'm giving you exactly 5 minutes only. So, how many were able to get that question correctly? How many were able to get that question and even scroll the answers for you to mark for yourselves? In the comment section, is there anybody who was able to compare their answer with the answer given the solution and they said, hey, we are reading on this thing? Is there somebody who got it right? Now, ladies and gentlemen, remember the question. If you could scroll it up, I believe you guys see the question. The question is for us to compute the material usage operational variance. So material usage, operational variance. Material usage, operational variance. So in short, they want us to give them the operational material usage variance. So the operational material usage variance, what do I have in brackets? We have a usage variance is standard quantity minus actual quantity. And then outside, of course, we have the standard price. So ladies and gentlemen, don't forget that this is standard quantity for actual production. Standard quantity, please write this in full. It is SQ for actual production. It is SQ for actual production. SQ for actual what here? Production. And again, remember, operations. We are comparing between the revised. So this has to be revised here. And this has to be actual. We are comparing between revised and actual. So the revised standard quantity, the revised here is 4. So we have 4 times the actual production. The actual output was 6,000. The actual output was 6,000 minus the actual quantity used. The actual quantity of materials that was used was 26,300. 26,300, multiply this with the standard price. You always get students arguing that they'll make use of no. When we talk of standard price, it must be original. So the original standard price here was what here? Somebody per kilogram? 5. Which in this case here, at the end of the day, we got what figure at the end of the day? What figure were we able to get at the end of the day, ladies and gentlemen? Ladies and gentlemen, what figure were we able to get at the end of the day? I'm so sure most of us got this right. I'm so sure most of us got this right. I'm so sure most of us got this right. What figure are they getting there? What figure are they getting there?
11,500.
Thank you very much. So, ladies and gentlemen, we'll take a 5 minutes break. We'll take a 5 minutes break. When we come back, I'll be able to tell you what we shall be doing next. 5 minutes break kindly. Okay, ladies and gentlemen, so I would want us now to look at the qualitative aspects of budgeting, So, of course, as you are aware, the topic is called budgets and what here? Variances. The topic is called budgets and variances. They normally go together hand in hand. Because I've got a few minutes left here, it will be important for us to see a few questions, theoretical questions of budgets. So first of all, it will be important for us to know that a budget is a quantified plan. A quantified plan, of course, which makes reference to a definite period. A definite period. So we quantify. It's a quantified plan. It's a quantified plan. We have got various ways of coming up with budgets, ladies and gentlemen. For example, we have what we call the incremental budgeting system. Incremental budgeting system vis-a-vis zero-based budgets. So we have an incremental budgeting system vis-a-vis zero-based budgets. I would want a good student to differentiate between the two systems of budgeting for us. Who will be able to differentiate between the two systems of budgeting for us? How does the incremental budget differ from the zero-based budget? From the zero-based budget, who is able to tell us the difference, ladies and gentlemen, there? Is anybody who is able to comment there? Incremental versus zero-based. Incremental versus zero-based. So what you're supposed to know, ladies and gentlemen, incremental budgeting system like the one that is normally used by Kenya's government normally makes reference, this one normally makes reference to previous budgets, previous period budgets, previous period budgets, which will be adjusted to give us the future budget. To give us, or rather to give us, for example, if we want to come up with a budget for the year 2020, the thing that we need to do is to get to our archives and get the budget for 2019. And then we adjust the figures to reflect inflation rate in the year 2020, to reflect, for example, new activity levels in. So you can say that 2020 budget, for example, will be equal to 2019 budget times 100 and what here, 10%. Meaning that we are only increasing the 2019 budget by 10%. Increasing, of course, we don't expect budgetary items to go down. And that is why, if you remember our budget, sometime back our budget was in 100 millions. It went to billions just the other day. Now we are talking of trillions, etc. Because budgets are not expected to do what to reduce. Incremental is so bad. Why? It encourages wasteful expenditure. Incremental budgeting encourages wasteful expenditure. Why? Because we know under incremental budgeting system, people are normally pushed to finish their budget. It's a crime. Under incremental budgeting, it's a crime if you do not finish your budgetary allowance. Because what will happen next year, when you come for your budgetary allocation, and you are not cleared your last year's allowance, will not be able to increase for you. So it encourages managers, in these cases and gentlemen, to ensure that they burn the budget. In NGO world, they talk of burning the budget. You burn the budget, finish everything. That is an incremental budgeting for you. It's a bad one. It leads to what we call slacks. It doesn't matter how you performed last year, we'll only keep on doing what here, giving you an extra 10% as the years, in this case here, come by. Quite a bad system, which is opposed to what we call the zero BB, the zero-based budget. Ladies and gentlemen, the thing that you're supposed to know under zero-based budget, we are never given any budget. So in this case here, we budget from scratch. Here we budget from scratch. We budget from where? From scratch. We budget from scratch. So we don't make reference to the previous period budget. We are going to start preparing our budget, assuming that this organization has just started. So all the previous budgets here, we throw them. And then the current period budget will be done from the very beginning. So under zero-based budget, everything is normally done from scratch. And remember, under ZBB, you must always justify. You must come and tell us that you as a manager who needs some allowance, why do you need this allowance? Remember the steps of ZBB. The steps of ZBB, how do we come up with this? First of all, we come up with the decision packages. Alternatively, what we call the activities. What activities are we going to undertake in the coming year? You come up with them. Number two, of course, we'll come and do what we call rank. So you rank them. You rank those activities. Of course, you'll not be able to finance all the activities. And that is why we brought in the concept of justification. If, ladies and gentlemen, you're not able to justify why you need a particular activity, allowance for a particular activity, then we will not be able to allocate resources to that activity. So the last step is to come and do what here, somebody, to come and allocate. So in most cases, they will ask you to define ZBB, and then if you look at your past papers, and then you give us the basic steps of coming up with a zero-based budget. Let us hang a few questions here for ourselves. Let's hang a few questions here for ourselves, a few questions here for ourselves. A few questions here for ourselves before we break. A few questions, ladies and gentlemen, here for ourselves. Yeah. You can see like question number 64. We start with question number 64. Question number 64. Let's go down a little bit, just a little bit. Question number 64. Question number 64. They're saying there, some commentators argue that with continuing pressure to control costs and maintain efficiency, the time has come for all public sector organizations to embrace zero-based budgeting. There is no longer a place for incremental budgeting in any organization. That should be the case. But like in Kenya here, I can assure you there are very few organizations that make use of ZBB. All of us, including us at our school, we use an incremental. We really get last year's budget, we build up a few things here and there, do some incremental. ZBB is quite costly also to put up, although very beneficial. So, particularly public sector ones, where zero-based budgeting is far more suitable anyway. Required. Discuss the particular difficulties encountered when budgeting in public sector organizations compared with budgeting in private sector organizations, drawing comparisons between the two types of organizations. So can somebody talk to us? Can somebody talk to us? What do you think will be the biggest challenge of coming up with a budget for a public sector organization? What do you think is the biggest challenge? Where do you think, in this case here, very many counties will do very wonderful budgets? When they take them to the county assembly, they are not even accepted. What do you think is a major challenge of coming up with a budget in a public sector, like a parastatal, like a ministry, like a country, a public sector organization? What is the major challenge of budgeting in a public sector organization?
There is justification. Resource allocation cannot be predetermined.
Resource allocation, ladies and gentlemen, for public sector, according to EVA, cannot, the resources here can't be determined in a, no.
Political influence.
Political influence that I will be able to buy. Given that, under public sector organizations, we have got various interests. So you always have a lot of noise in the system. So when there are a lot of noises in the system, and you've got to balance everything here, you have to hear every noise. That really will make the process of budgeting a cumbersome affair. And that is why you will get, like in Kenya, we have basically a budget office. We have actually like an institution, which is basically out there to be making budgets every other day, every other month, every other year. Simply because of how rigorous the budgeting process is. So I'll buy that. The political interest, yes. Any other point? What do you think in this case here makes really budgeting in public sector organizations where most of you, of course, work, where most of you will be working, quite a cumbersome thing?
Time consuming.
Time consuming, decision making is not easy. Please read all of them. Corruption, yes, because there are people who believe that they have to pad budgets with their greediness, bad appetites.
It's lengthy and time wasting.
What makes it to be lengthy? That is a question. What makes it to be time wasting?
Personal personal interest over
personal interest. Ladies and gentlemen, there is one thing that I'm not hearing you guys talking about. Contrasting the objectives. You see, the major objective of any private institution like our college is to maximize what here? Profits. We want to maximize profits, nothing else, nothing less, nothing more, nothing less. Maximum. So in this particular case, our metrics are very well defined. Our metrics are very well defined. How about in this case here, the major objective of these, like parastatals? Like for example, Kenyatta National Hospital. Their metrics are purely qualitative in nature. They are qualitative in nature. You can't quantify, you can't tell us, for example, that Kenyatta National Hospital's objective is to maximize profit, you start looking at the profit element. No. I mean, their objectives are what here? Qualitative. For example, how many cancer patients came on board and they've been able to treat them? How many? So when objectives are qualitative in nature, it becomes very hard even for you. You know, to do a budget, you need an objective. You need an objective. If it's profit, I want to know this department is contributing how much in terms of profits, we give it these resources. But now for a hospital where you don't have a clear-cut objective, where in this case here, the objective there is qualitative in nature. Like you'll see how they have given us this answer, the answer here, like an ambulance, for example, should be able to reach some patient in how many minutes? So if you say, for example, 20 minutes, there'll be people who will be crying still outside there that 20 minutes is way too much because there are people who will die within 5 minutes. So it becomes really hard because of the qualitative nature of objectives of public sector, The objectives of public sector, ladies and gentlemen, you don't even have clear-cut outputs. That is why you will get serious managers, they get from private sector where they were shining. But when they are appointed here to go on ahead like a parastatal, they can't even last for a year. Because you see, even the CEO of Safaricom, when he wakes up in the morning, he knows clearly his key performance indices. He'll tell you in a day, he expects this sales revenue. Expenses must be within this range. But when you go to the public sector like a hospital, defining outputs nicely will not really impress everybody. You can't impress everybody. So there are various stakeholders, and these stakeholders, given the political interests, given this and this, changing things in between, like political management can change in between, bringing in new ideas, etc. That really complicates everything for us, I'll be able to give you the answer for that. Look at part B of the question. Part B, they want to explain the terms in incremental budgeting and the zero-based budgeting that I've done. Look at C. State the main stages involved in preparing zero-based budgets. I know them. Number 1 is activities. Number 2 is rank. Number 3 is allocate resources. D, discuss the limitations and possible advantages of ZBB within a public sector organization. Ladies and gentlemen, the major limitation of ZBB, coming up with a ZBB budget, is time consuming. Being able to define all those activities is not a simple thing. It's time consuming. It's a costly thing. Again, ZBB to some extent is a subjective budgetary process, subjective. It depends on who is looking at the activities. Who told you that activity A should be number 1 or activity D should be number 10? So we have the concept of limitations or disadvantages of ZBB. Number 1, we've said the issue of what here, subjectivity or biasness. Time consuming. It's a costly model. However, it has got its major advantages as well. The major advantage of a ZBB, ladies and gentlemen, will be the concept of ensuring that, I want to repeat this and repeat this severally. Remember, under incremental budgeting, we were able to build up slacks, leading to slacks, SLACK, surpluses. We're able to build them, leading to what here, wasteful expenditure. ZBB will be able to cut on this wasteful expense because ultimately, under ZBB, If we realize this year you are wasteful, next year we will not give you any allowance. So we are able to cut on this wasteful expenditure. If my friend here could go to page, not page, but answer number 64, just scroll down to the answers until you see 64. 64, 64. Must be about 100 pages down. So move speed. Move, move, move. We start seeing one again. We will start counting. So I'm sorry there are students who asked for these ACCA materials yesterday. I was not able. Yesterday I was in the studio most of the day. But today I'm a free man from 10:30 all the way to 2 p.m. I'll be a free man, and as such I'll be able. So I should be able to send them today. Until you get to question number 64, just continue. Almost there. So move down a little bit. So question number 64, like if you go to part A, you'll be able to see difficulties when budgeting in the public sector. The main objective for most companies is to maximize what? Profit. Effective budgeting can assist in meeting this objective by focusing efforts on reducing certain costs and increasing revenues by a certain amount or percentage. The objective of public sector organizations are more difficult to define and a quantifiable way. Those are things you'll be able to read on yourself. We have where they wanted us to define incremental budgeting. You can see here, in incremental budgeting basis, the budget on the current year's results plus an extra amount for estimated growth or inflation next year. This form of budgeting is a reasonable procedure if current operations are effective, efficient, and economical as they can be. Zero-based budgeting, ZBB rejects the assumption that underpins the concept of an incremental budgeting, that next year's budget can be based on this year's cost plus an extra amount for estimated growth or inflation. ZBB involves preparing a budget for each cost center from a zero base. Every item of expenditure must be justified in its entirety in order to be included in next year's budget. Stages in zero-based, we have defined activities through donation packages. We have evaluate and rank each activity, and then we have allocate resources, allocation of resources. We have limitations of ZBB. These are things you'll be able to read on your own. So, ladies and gentlemen, is there any student who has any question? Is there any student who has any question? Anybody who has any question, please talk to us. Please talk to us. Is there anyone who has any question? How can we get the book? Those ones who had written WhatsApp messages to me, immediately after this, I'll be able to send the book to you. Or is it possible they pick it from here? There must be a way they can pick it from here. If you just hang it, there must be a way. There must be a way. There must be a way of sharing this document and then pick it from here. There must be a way. Share? Just the screen. Geoffrey is asking whether the two types of budgets here, whether they have any mathematics. No. No, they don't have any mathematics there. But remember, also when we come back to our next class, we'll be seeing we have got other forms, other forms of budgeting. For example, what we call participative budgeting. Participative budgeting. Participative budgeting, a participatory budgeting style, ladies and gentlemen, is that style of coming up with a budget where we have the people at the bottom doing the budgets. They discuss quite intensively, and then of course they bring up the thing to the top management for some few adjustments here and what here implementation. It's also called the bottom up, where you have everybody. People in this case here will be able to give us ideas, etc, etc, etc. We shall be able to look at that later on. Remember, if you look at your past papers, theory for advanced MA normally comes up to 30%. And most of the theories normally come from budgets, environmental management accounting, and some few also theories from CVP. But budgets and environmental management accounting theories are very popular. And of course, if it's budgets, mostly it's ZBB, incremental, you'll be able to see in your past papers. And of course, for those of you who have got these revision kits, when you go to your variances budgetary, you'll be able to see all those particular